Good afternoon, everyone, and welcome to this week's episode of a Junior VC Behind the Scenes. We're here to talk about D-Mart. They recently announced they had a great quarter. It was a 25% year-over-year increase from last year. They're on track to do 40,000 crores in revenue, and it makes their founder, I believe, the third richest man in India. So, Aviral, let's jump into the story. First of all, can you tell our listeners why we chose to talk about D-Mart this week?
I think it's an interesting story because of so much conversation around IPOs. When we talk about IPOs, the DMart IPO specifically, you'll realize why we picked it in the IPO context. But I think for a while we've been wanting to deep dive into a retail player in India. Sometimes we go beyond the startup mandate and look at these companies when they started up. And again, like with most HDFC pieces, we didn't find a comprehensive place where everything about DMart was talked from the beginning till today. So we thought we'll give it a shot.
Awesome. So let's jump into the story, starting off with the founder's origin stories. I believe he was actually a stock market investor back in the 90s.
Correct. So, very interesting background. So, Mr. Damani, who is the founder of D-Mart, he was born in Bikaner, more famous for its namkeen and Haldirams and Bikaji. Haldirams, obviously, we've written about. But his father was a stockbroker, very middle class family. Mr. Damani started as ball and bearings trader, but with his father's untimely demise, he had to switch to a more lucrative business because his ball and bearings business was clearly not working. So he joined stockbroking with his brother. Now many of us would have seen the TV series Scam 92. There are enough reports that say that Damani was played by one of the four actors around, which was a short-selling bear cartel led by Cobra. So Damani, he grew in the trading / investing business. Initially, he was just a trader, and he found himself going up against Harshad Mehta, who was the big bull of that era. There was Rakesh Jhunjhunwala and Damani, who both worked on the opposite side, where they were short selling and Harshad Mehta was going long. And I think for many years their battles continued. Apollo Tyres was a big one, which Damani lost to Harshad Mehta. And nobody really understood where Harshad Mehta's funds were coming from. Eventually it was revealed that there was a large scam with a big loophole in the banking system being exploited in 92, and eventually Damani and co, they won their short selling battle. There's a story where Damani talks about how he was just a week away from bankruptcy, because when you go short, you need to eventually cover your positions in case the stock price doesn't fall as expected. And if Harshad Mehta wouldn't have been caught out, Damani was a week away from bankruptcy. I think that was transformational for him. I think the first transformation in his journey. He decided to start investing rather than trading, which is going long. And we all know Warren Buffett. So he's a big believer in the Warren Buffett story. Apparently, he was one of the largest shareholders in HDFC in 95. And somebody asked him why he's continuing to buy such an expensive stock. He said that you can't live on Pedder Road paying the rates of Dharavi. I think it's quite interesting how he went like all in on HDFC. So for the 90s, he was a long only investor, more classical style. Same time, I think, as Jhunjhunwala also went from short selling to eventually becoming the big bull. There was another, arch nemesis now in the stock market, which was Ketan Parekh, who came against Damani again. So from Harshad Mehta to Ketan Parekh, there was an interesting Gujarati versus Marwadi dynamic that was playing out, and it was very strong in the 80s. So I think, Damani tried his hand at retail with a failed venture called Apna Mart. He acquired a very old business and tried to run it like a socialist company. Eventually, it didn't work out. And, in 1999, when technology went up, it seemed like Ketan Parekh was doing really well. He bought a lot of software stocks, and Damani obviously understood the more classical parts of the stock market. So he was good at cement, commodities, industrial, and others kind of things. So I think a combination of wanting to build in retail and not seeing as much success as he did, although he was very wealthy and quite successful by then, he decided to call it quits from the stock market and go deeper into building retail. So it's like his first chapter itself is a TV series, which is quite interesting. But his latest chapter is even more interesting. So that's how I think the story of his retail journey began. He started a company called Avenue, which is actually the name listed name for the company that owns DMart. But DMart was not what he started with. So he started by saying that I'll do something in retail, and he just called it Avenue and then waited it out, trying to explore the market.
So let's maybe jump into that, and thanks a lot for that 5-minute overview of, like you said, what could have been a full TV show about the stockbroking in India in the 90s. But let's dive into the problem that DMart is solving. So what was the opportunity that Damani saw at that point in time?
So there's a lot of similarity with this large conglomerate that now owns a large e-commerce company in India called Walmart. In fact, Walmart is called Walton Mart after Sam Walton and the Walton family. D-Mart is Damani Mart. So there's a common genesis as well for this new business that Damani was starting. I think his idea was to essentially create organized retail for the Indian middle class, and this is not, most rich Indians call themselves middle class, which is kind of funny. The top 1% of people who earn quite a bit say that I'm an Indian middle class person, which is weird because the middle class is not them. So he's actually thinking that let me do something for the Indian middle class, let me do something for the mass consumer. So very low cost operations, very attractive prices, very limited SKUs and inventory, and very limited, diversity in terms of like just brands. So he thinks of like creating a Walmart style business in India. He starts with Powai in 2002. And he calls it D-Mart. Like I said, the origin for D-Mart is his name. And Powai then was not upmarket Bombay, right? Today, obviously, there's Hiranandani, and Hiranandani is another story where they built out this amazing apartment complex in basically wilderness 20 years ago. And now, I think the real estate of that area is probably one of the most expensive in Bombay. But then Powai was not really upmarket. It was a suburb. I still think, because D-Mart has never closed, the same D-Mart store in Powai in Hiranandani runs today as well. I remember visiting it when I was in college too, so I know where it is specifically. And the interesting thing was, he took 3 years to start the first store from when he started Avenue Supermarts. It was very thoughtful, and he took another 5 to 7 years to start another 10 stores. So it wasn't really hyper scale from the beginning. He was trying to figure out a model that works, and he was trying to figure out something that would eventually make sense economically.
And so from those humble beginnings, let's talk a bit about the size of the market at that time, in the mid 2000s. Um, can you tell our listeners how big was the market and what was the potential for growth?
So, India's retail market today is close to a trillion, but then it was half, 400 to 500 billion. Organized retail was a minuscule percent. It still is a minuscule, but it's a bigger minuscule percent today. Um, so the market that DMart was going after was literally like 10 to 20 billion dollars, and there were already existing players of multiple types. Um, a lot of big players had started to explore India. Obviously, Walmart with Bharti Airtel in 2006, Carrefour and others also said that they would start. Reliance was starting to make big inroads, and there were
Competition
these,
is really heating up.
two young. Correct. Competition was heating up, and then there was these new companies, Future and Spencer. Future Retail would eventually become huge, but then we know the story of what happened after that. So there were these big players that were coming up. Malls were sprouting all across India, um, and this new movement that had begun. India went from, I think, a GDP of close to 270 billion to 820 billion from 92 to 2005. So it was 3x in 13 14 years, and retail also followed. So the market overall had expanded. It was largely served by disorganized retail, which is the kirana stores that we all know. They still exist, and the reason they exist is because last mile is so effective with them. But organized retail was really, really small. So for a large player to come and build, it was already quite challenging, and I think the economics didn't make sense, which is why many people didn't decide to do it.
And let's zoom in to the unit economics for DMart and what their solution was. How were they able to find their niche?
Yeah, so I think they have been profitable every year since they were founded. They've had a razor sharp focus on ensuring profit margins are there regardless of how low they may be. In fact, I think for the last 3 4 years they've been around 4 5%, but they've not really gone down. They've remained where they are. And their focus on a bunch of things has allowed them to keep costs in check. For example, they treat their vendors really well. They buy wholesale, they pay fast, so they don't really have inventory issues, they don't really have payment issues. They're able to pass all of these savings to their customers, and then you have this really interesting flywheel that's turning with customers coming for the low price, vendors getting attracted because there's a lot of volume, and payment terms are amazing. I think they pay within like 7 days versus the market, which pays 30 45. So customers love it, vendors love it, and there's always a network effect and a flywheel that's turning. So more customers attracting more customers, more vendors attracting more vendors. A classic marketplace model, but this is physical. So by ensuring wholesale buying and by keeping prices in control, in check, keeping inventory as low as possible, they were able to manage costs. The other interesting thing that they've done, which is kind of unique, is their advertising and promotional expenses are basically zero. I don't think anybody remembers seeing a DMart ad, but everybody knows about DMart. So there's obviously something that they're doing. I kind of joke that DMart opening in a neighborhood is an event, and like I've heard people saying, "Oh, there's a DMart now." I think one thing they did really interestingly was they retained their customers with their service, and the word of mouth and quality is what attracted everybody. So they didn't really need to spend on advertising. So you're spending less on cogs. You're keeping prices under control. You have zero advertising as a line item, and then they never really hired people who had pedigree and could be expensive. They hired people super young, fresh, trained them, and I think that keeps employee expenses low. So the overall cost structure of the company, even though their gross margins are not very high, they would keep advertising at close to zero, employee expenses at 2 to 3%, and eventually your profit margin would work out to be 4 to 5%. So I think they've created a very interesting model where they've kept everything as required and not really gone crazy. Even if you go to any of their stores, you'll see that they're very minimal. There's not too much jazz, and that keeps the cost of running these operations. They usually take like some rundown warehouse or go down and they repurpose it to become a store, which is again fascinating from a model perspective. So yeah, I mean, I think it was very interesting. I think in mid 2014, 2015, they had close to 70 stores, and they were doing close to 5,000 crores of revenue, which was like 70 crores per store. And the competitors were doing 5 to 7 crores per store. So it was pretty crazy how they were able to drive efficiency, scale, as well as economics through that.
No, it's amazing. I mean, they started small, low scale. They kind of perfected the model, and once they got it right, they could really grow. Around 2015-ish, after almost 10 years of really iterating on the model and finding the right fit. Can you tell us a bit about that growth phase,
Right.
and how they kind of scaled?
So I think by around 2014-15, they had got a sense that the model was working. There was obviously Future Retail, which was a big competitor. Interestingly, Future took on a lot of debt to service their expansion and going into different lines. Spencer Retail, owned by RPG, they were also a competitor. I think D-Mart understood it's not really a small segment, it's a big segment that they're going after. And they started replicating this in more areas. Interestingly, if you look at the store expansion strategy, they would go after higher income states, although they were middle class. So wherever there was a propensity to pay, they would look at those states. So even today, they are in states where incomes are on average higher. And they're very strong in the West to begin with, like Maharashtra and Gujarat were their big areas. So they started scaling, adding stores, from 70 to 150 to 200, and they went public. And I was talking about the IPO in the beginning. They listed at 300, and the IPO doubled, the price doubled next day, and the IPO was 1000x subscribed. The company has not seen the IPO price ever again, right? So it's an incredible story of value creation. It's a lesson for many founders on how to take a company public and price it well. I think the IPO was Mr. Damani going back to his old love after 20 years, going to the stock market and raising money. And I think they needed it because they needed to scale. But even since they've gone public, they've not really lost sight of what they stand for and what they want to do. So I think it's a very interesting journey since then.
It really has been fascinating how he's come full circle and ended up as a public company that he built. But after that phase, I think once they went public and you got that capital, competition really heated up. I mean, it was big companies like Big Bazaar, Hypercity, Megamart, Spencer's as well. And you've spoken about how they, made a conscious decision to not spend money on advertising. Can you tell us a bit more about that, and how did they fight competition without spending the money on ads?
So they remained razor focused on their segment, which was very cost conscious and not really solving for convenience, which could be the other categories. I think Future, with its expansion, took on a lot of debt. And by the time 2020 came, it was a moment of reckoning for the industry, right? D-Mart, which had been lean operations, never had bloat, was profitable, making money. And Future Retail, which had taken on a lot of debt, was losing money, obviously, due to its expansion strategies. The pandemic happened, and as you know, retail's you know, bloodline, lifeline is footfall. People stopped coming to these stores, and Future, which was anyway starting to show signs of trouble, it just collapsed, right? Its stock price went down by 80% in 4 months. Reliance was supposed to acquire it. Amazon decided to, you know, come into the mix and say, hey, you know, we had right of first refusal to buy this business. And eventually Future was like this dead animal which was being picked off by Reliance. I think today Reliance has essentially just not paid anything and kind of acquired all the stores of Future. So Future was like dead. Future was killed by the pandemic. Spencer is still alive. It's not like gone away, but like DMart has not seen its IPO price, Spencer has also not seen its IPO price, just that it's 80% down from its IPO price, not up like DMart. Um, and you know, DMart was in real stress because they obviously didn't have footfall and they didn't have an online presence. But I think this is where, you know, I always say bad luck exposes incompetence. So the incompetent players were out, and it just left DMart and obviously Reliance, Amazon, Flipkart did super well because of e-commerce. DMart added DMart Ready and online services, but that's obviously not their core. They've still managed to take that and make economic sense out of it. I think their losses have reduced. But post the pandemic and things opening up, DMart has come out even stronger. I think now people are going physically to stores. They obviously don't have too much competition now from the players that existed, but there's Reliance Retail, which has become huge. Amazon, Flipkart obviously are big. So the players have changed, but the original players that DMart had to contend with, they aren't there anymore. So I think there was a moment of reckoning in 2020, and DMart has proved that it's been resilient. I think its stock price today is 3,500. If I'm not wrong, it's 10x its IPO price. It's fascinating how they've executed. They've remained really lean, and even today when they are at such scale, they're at 10 to 12,000 crores of quarterly revenue, which would be around 40-50,000 of annual revenue. They're still not at thousands of stores, they're just at 300. So they've still stayed true to their roots and what they had initially started out with.
It's an incredible story. And to wrap it up, what does the future of DMart hold after 2 decades of completely different competitive landscape, going through demonetization and then COVID? What's next for them?
I think, the interesting part is they've grown by 25%, but their stock price fell when they announced the results a few days back because people had more expectations from them, which is quite interesting. And that will lay the foundation for the future. The company has now a very different set of challenges. It's not a young startup. In some sense, it's become quite large. And when you're large, growing is harder. So the ability to grow is difficult. I think they're going to have to contend with large player problems, which is when you're a large player, what do you do? One of the challenges that they have faced, obviously, is that they have been focused on a particular set of geographies, so being able to diversify to other markets. For example, they're not there in UP today. How do they diversify geographically? They'll have to think of a few more revenue lines. They could potentially look at Aldi and Costco in the US, which have done interesting things for the same categories, so subscriptions or private label. Those are things that they'll have to explore. But I think for the company, they'll have to go deeper and wider in India, which till date they have not gone as deep and wide. I think that's going to be their next leg and next challenge, and how they will execute. But till date, they've remained very true to their ethos. I'm curious to see how this will play out if they take the same playbook and replicate it in other markets which are not the same as they're originally already existing markets.
Thank you, Aviral, for that amazing overview of D-Mart's incredible story. It's been quite the journey, and thank you everyone for tuning in and listening to this week's episode of a Junior VC Behind the Scenes. We'll see you again next week with a fresh episode of Founders Unfiltered.